Hola, muy buenos días. Bienvenidos a este tercer día de nuestro ciclo de conferencias remotas respecto del Tratado de Libre Comercio entre México, Estados Unidos y Canadá, el T-MEC. Esta mañana vamos a iniciar hablando de temas que no estamos muy familiarizados, pero creemos que son muy conveniente conocerlos en relación a nuestros socios comerciales. Entonces, vamos a entrar en materia y antes de presentarles la conferencia, el tema de la conferencia, me gustaría presentarles a nuestro invitado. Nuestro invitado es Paul Burns. Él tiene más de 30 años de experiencia asesorando a clientes en todos los aspectos del comercio internacional e impuestos a productos básicos, incluida la asesoría en control de exportaciones y aduanas canadienses. Por muchos años ha desempeñado el rol de coordinador del Grupo de Práctica Comercial Internacional en la oficina de Toronto de nuestros aliados estratégicos en Baker y McKenzie en Canadá. Paul ha asesorado a compañías multinacionales en una serie de asuntos de comercio internacional, Tratado de Libre Comercio, incluyendo el Telecan o el NAFTA, y ha asesorado a clientes con auditorías tanto internas como por autoridades regulatorias internacionales. El desarrollo de estrategias aduaneras y programas de cumplimiento y apelando a determinaciones desfavorables por parte de autoridades gubernamentales, incluyendo apelaciones ante el Tribunal Antidumping, el Tribunal Canadiense de Comercio Internacional y los paneles binacionales, establecidos bajo el Tratado de Libre Comercio, el Telecan entre México, Estados Unidos y Canadá. Paul, we really thank you for collaborating here. We could not go through the implementation of the new USMCA or CUSMA, as it's called in Canada, right, or the T-MEC in Mexico. we could not talk about the implementation without considering also the implications of key elements of the implementation for Canada. So we are very pleased to have you here. Thank you very much for coming with Index, the maquiladora and manufacturing industry in Mexico, very relevant to the agreement to the North America region. And we're going to be pleased to have you here and listen to your consideration, to your speech on key Canadian custom changes and value for duty requirements under the new agreement, the new T-MEC, the new CUSMA or USMCA. Paul, please be our guest. The audience is yours.
Thank you very much, Israel, and I'm extremely pleased to be able to participate in this program today. It's a wonderful opportunity for me, and I am very excited to take part and to be given this opportunity to bring your members the sort of the Canadian take on, as you say, I'll call it the CUSMA or T-MEC. Being a Canadian, I typically do refer to it as CUSMA. In my talk today, I'm going to focus, I think, on some points that maybe have been stated by some of the other speakers, but I'm going to just elaborate on a few points and focus really on some of the Canadian implications of this new agreement that may be specific to Canada, that may be of interest to the participants today. And as you said, towards the end of my presentation, I'm going to focus on two Canadian value for duty issues that are very significant in that they come up all the time in audits, and we see a lot of non-compliance with respect to companies who are exporting to Canada, and maybe with CUSMA, coming on July 1st, which is fast approaching. It'll be an excellent time for companies not only to fully understand and appreciate what CUSMA requires of them in order to claim preferential tariff treatment. But at the time that exercise is being undertaken, to consider also, have they been declaring with their affiliates or their customers the correct value for duty when these goods are imported into Canada. So from my perspective, I think it's a wonderful opportunity for companies to kind of reset, and we'll talk more about that when I talk about the rules of origin, but to really take a look at their compliance programs, make sure that they are fully compliant and understand these new rules. So if you can, switch to the next slide, which is sort of my introductory slide. The two valuation areas that I'm going to cover deal one with retroactive transfer pricing adjustments, and the other with this unique Canadian purchaser in Canada requirement. And that one in particular, because it is unique, Canada causes all kinds of problems for particularly, it seems, related companies selling to their affiliate in Canada. So with that introduction, I'll turn now to the next slide, actually 2 slides from now, which is the beginning of my discussion about some key Canadian customs changes, starting with the rules of origin. And as I'm sure most of you know, that in order to claim the preferential tariff treatment, goods must meet, prescribed rules of origin, and the importer must have a certification of origin at the time the goods are imported. Now, I'm not going to review these rules in any detail at all, because I'm sure other speakers have done that, but I do want to highlight 2 things in particular with respect to the rules. And the first is that it's imperative that the exporters or producers, do the required rules of origin analysis before making that certification and providing it to the importer. You cannot just assume that because the goods qualified under the NAFTA, that they'll qualify under the CUSMA. And there's a number of reasons for that, but primarily, while many of the rules of origin have stayed the same, there are some significant changes to the rules, and because the rules have changed, you need to run through the rules of origin analysis to confirm that your goods that used to qualify under NAFTA will qualify under CUSMA. And in particular, in the automotive sector, in the textile sector, there's been significant changes to the rules. Now, the flip side, though, is also true, and this presents real opportunities in that you may have done the rules of origin analysis for your goods under the NAFTA and concluded that goods don't qualify, but you should do the rules of origin analysis again under the CUSMA, because under the new agreement, those non-qualifying NAFTA goods may be qualifying under CUSMA. And there's one key change that I want to point out that could lead to this result, and it's as a result of a change to what we refer to as the de minimis rule. And the de minimis rule essentially provides that if the value for duty of all the non-originating materials used in the production of a good that don't undergo the prescribed change in tariff classification is less than a specified percentage, the goods will nevertheless qualify. In other words, if you have non-originating goods that don't meet the change in tariff classification test, if their value is less than a specified percentage, the goods will still qualify. And that percentage under NAFTA was 7% or is 7%, but it's being increased by 3 percentage points to 10% under CUSMA. And as a result, those 3 percentage points could be the difference between a non-qualifying NAFTA good qualifying under CUSMA. So there's an example where the change in the rules could be of a real benefit to companies in terms of their compliance or their ability to qualify. Another important change is that for certain goods, they need to meet what's called a regional value content calculation. And normally you treat the value of any non-originating material that's used to produce the finished good as 100% non-originating. it was what CUSPA makes clear is that if you have the requisite information, you can take a non-originating material and determine, if you can determine the value of the originating content in that non-originating material for purposes of the regional value content calculation, you can capture and pick up the value of the originating content in the non-originating material. So I think that's also a significant change that that one ought to keep in mind when you're doing your rules of origin analysis. And then lastly, in terms of goods qualifying and not qualifying, or not qualifying and becoming qualifying, what we've seen over time is that companies spent a lot of time and effort when NAFTA was new to do rules of origin analysis, become experts in the area, go to seminars, and implement programs. And over time, that intellectual capital is sort of withered away in many companies. And we see companies now today actually issuing certificates of origin under NAFTA, and the person is doing that on the basis that that's a document needed to ship to the US or Canada, not even understanding there should be this underlying rules of origin analysis. So it's important that that analysis be done now, because as I said before, not only have the rules changed, but your supply chain could have changed. And where before a key originating component or material was purchased within the North American Free Trade Area, it may well have over time the source of supply changed, and now you have a non-originating material and didn't realize it. And we see in many instances that the trade compliance people aren't necessarily told of changes that their purchasing colleagues have made. And the other thing I would say too is that with the COVID-19 pandemic, we're seeing many companies very quickly switching their supply chain. And as a result, the rules of origin analysis that had been done in the past definitely needs to be redone, because significant changes in supply chains may have occurred as a result of the pandemic. The next point I want to make is with respect to certificates of origin. A key point is that if you have NAFTA certificates of origin, they cannot be used to support preferential tariff claims under CUSMA. You will need a CUSMA certification of origin, and there seemed to be some confusion about that, although it seems to be better known now that NAFTA certificates of origin will no longer be acceptable. And it's important, actually, with the July 1st fast approaching, that importers and exporters and producers, all get their house in order in terms of the certifications that are required. Unlike NAFTA, which required a prescribed certificate of origin, under CUSMA, there is no prescribed form, but there is prescribed content. And another key change is that under NAFTA, only the exporter could issue the certificate of origin. Under CUSMA, the exporter, the importer, and the producer can all issue certifications of origin. I would, though, note and caution that with respect to importers issuing certifications of origin, based on our read of the agreement, it appears that the importer cannot rely on a certification of origin issued by the exporter or producer, that in order for them to issue their own certification of origin, they would need to do the rules of origin analysis themselves or have that information available. And clearly, outside of a related party transaction, that's not likely to occur. However, with respect to maquila companies that are related to, say, their parents in Canada or the United States, if that parent in Canada is the importer, it may well have all the information to do the rules of origin analysis, because it's the principal in the maquila structure with the Mexican company. So there's some fine points with respect to certification that will need to be considered as we move to July 1st. The other point I would make too is that not only will importers need these new certifications by July 1st in order to claim the preferential tariff treatment, if you're a producer, you should be reaching out to your sources of the raw materials and inputs that you purchase in order to produce your finished materials to get the customer certifications you need to determine whether those materials are originating or not. And again, I think that there was an expectation by many, notwithstanding the Trump administration's desire to get the agreement in place as soon as possible and before the U.S. election, that the agreement would be postponed. The implementation wouldn't occur until January of next year, but here we are with July 1st fast approaching, and so I think companies are going to have to move quickly. Now, technically, you're not supposed to claim preferential tariff treatment without a certification of origin, and I guess I'll just deal with it now, but there is the ability in Canada to claim a refund if you don't claim preferential tariff treatment up at the time of import. And another positive change under CUSMA is that under NAFTA, you only had 1 year to make the claim. In Canada, under CUSMA, you'll now have 4 years to make a refund claim for preferential goods. If I go to the next slide, please. Canada has this program called the Low Value Shipment Program, which essentially does two things. The first is that if it's a qualifying import, which currently under NAFTA, the threshold is $2,500, then there's a simplified process. Well, actually, origin's not relevant, but there's a simplified process for reporting, obtaining, release, and accounting for the goods and the documentation requirements. When CUSMA comes into effect, the threshold will increase from that $2,500 to $3,300 Canadian, and this program will apply across all commercial programs, regardless of the mode or stream of importation, and under all free trade agreements right across the board. So the program will not be limited to just courier shipments. And the other significant change is that under the NAFTA, if you're claiming preferential tariff treatment and the value for duty is less than $2,500, and for the other Canadian free trade agreements, if the value for duty was less than $1,600, you didn't need a formal certificate of origin. You could simply rely on a certification that appeared on the invoice or some other written document that the goods were eligible and originated. Now, as of July 1st, this is changing. So the threshold is going up for all imports to $3,300. And if you want to claim the benefits of a free trade agreement and the value for duty is less than $3,300, you will no longer have to have on the documentation supporting the shipment at the time of import a declaration or written statement saying that the goods originate. However, it's my view that in order for you to be able to claim the preferential tariff treatment, you're still going to need evidence or proof from the export producer that the goods in fact qualify. Okay. Moving on to refunds, I've already dealt with this. The good news is the refund period's going up from 1 year to 4 years in Canada. So that's a very positive development. We've had many instances where goods were eligible for NAFTA, but the claim wasn't made within the 1 year, and that it was statute barred. The importer was precluded from making the claim. If we go to the next slide, another significant change is that under the NAFTA, there were 3 different tariff treats for qualifying goods. Goods could either get what's called the United States tariff if they originated in the US, the Mexico tariff if they originated in Mexico, and if the good only originated by combining US and Mexican content, it got what was called the Mexico-United States tariff. And the reason they had 3 tariffs is because the phase-in with the duty reductions were different in the under the 3 different tariff regimes. Under CUSMA, there's only going to be 2 tariff treatments. The goods will either originate and benefit from the US tariff or originate and benefit from the Mexican tariff. Under the NAFTA, you used to determine which tariff applied by applying a different set of rules, the origin marking rules. And my understanding is under CUSMA, that will not be the case, but it's a much simpler test. You will determine the tariff that applies based on the country of last production, including if it was just minor processing. So that's a significant change that is going to make things much easier for companies who are claiming the benefits of the CUSMA and determining which of the two tariffs will apply. With respect to duties relief and duty drawback programs, there are no changes between what we have now with NAFTA and CUSMA, which is good because if you understand those rules today, there's nothing really to worry about in terms of changes. Many of you may know there's certain restrictions on refunds and drawbacks. There's something called the lesser of rule that will still apply, but there's no significant changes to those programs. Next slide, please. Okay. Advanced rulings. This has come up quite a bit. There has been some companies assuming that if they've got a NAFTA advanced ruling, that will apply to CUSMA, and the answer is it will not. CUSMA is a completely new agreement, and you have to start from scratch. However, if the rules of origin that you're relying on haven't changed between NAFTA and CUSMA, and the ruling you got was a complicated, I would recommend that you go and get a ruling from the Canada Border Services Agency, Canada Customs under CUSMA, and one would hope it would be a fairly straightforward process because you would say the rules haven't changed, we've got this NAFTA ruling, we would now like a ruling under CUSMA. And one would hope that that would be a simple process and you would get the same result, you'd get the same ruling. The reason for requesting rulings is so you have certainty as to whether your goods qualify and you're not dealing with an auditor that may not be quite as up to speed as, say, the officers who are issuing the rulings. So we recommend getting rulings, particularly where it's a complicated NAFTA rules of origin analysis, and there is a process for doing that. I believe that the certain the same at 120 days, but that'll be, whether that's met or not will be a function of how many ruling requests are coming in right now to customs to get the customs CUSMA rulings. Now the last topic I want to cover has to do with what we refer to in Canada and in the agreement actually as the de minimis rule. So essentially, when goods are imported into Canada now from any jurisdiction by the postal stream or the courier stream, and those goods have a value for duty of less than $20, which is really low, they can be imported without the payment of any applicable duties and without the payment of the Canadian value-added tax, which we refer to as the goods and services tax or the harmonized sales tax. As a result of the CUSMA negotiations, this rule is changing such that as of July 1st, for goods exported from Mexico and the United States to Canada via courier, so it's only courier, it's not the postal import stream, and it's regardless of their origin, so they don't have to be originating in Mexico or Canada. They may be imported into Canada duty-free if the value for duty does not exceed $150, and no VAT, no GST or HST if the value for duty does not exceed $40. Okay? Now, a couple key points. The first is that the goods have to have entered the commerce of the United States or Mexico prior to their being imported in Canada. In other words, you can't be importing product from China, moving it through Mexico, and then onward to Canada in order to benefit from this rule. And then secondly, as I pointed out, it only applies to courier shipments. So if you're a Mexican company and you have a mail order business or a web-based business, and you're shipping goods directly to your customers by post, and the value of your goods are less than these thresholds, you may want to consider changing to the courier stream so that you or your customers can benefit from these lower thresholds. Okay? So if we move to the next slide, I'm going to segue into the these two value for duty points that I want to quickly review with you. And the first has to do with the value for duty determined under the transaction value, which is the primary method of valuation. So if you go to the first slide, please, or the next slide. So many Mexican companies are related to the Canadian affiliates, could be parent sub or sub parent. And what typically happens, your income tax colleagues are always worrying about coming up with an arm's length transfer price based on a transfer price study or an APA. And generally, they're looking at the profits earned typically in the Canadian subsidiary. At the end of the year, if the profit's not within the targeted range, there'll be a year-end transfer price adjustment. And that can be an increase to the Canadian sub to reduce the profit, or a decrease to increase the profit, so that ultimately the transfer price is an arm's length price. And we see this all the time with subsidiaries of both US and Mexican companies. Now, here's the kicker. There's a concept in the Customs Act that says if the importer has reason to believe the value that was declared is incorrect, the importer has 90 days to file correcting entries to change the value, to correct that value. And so if the company, the Canadian subsidiary, was importing over the course of a year, and at the end of the year, the parent in Mexico decides that to get to the arm's length price, there's a year-end transfer price adjustment, a charge, then within 90 days of that being booked against the Canadian subsidiary has to file correcting entries. And you can do this by filing what are called blanket amending entries, and you request permission. There's a spreadsheet you use, and we help companies do this all the time, year over year. But the key is you have to do it within 90 days. The other point to make is that this is low-hanging fruit for auditors. It's very easy for the auditor to see whether or not there's been a transfer price adjustment and whether the value's been corrected. If you miss the 90 days, you can still do a voluntary disclosure provided certain conditions are met, and we've helped many companies do this as well. And the reason you do it is to avoid higher penal interest rates and penalties generally. Now, if you move to the next slide, I'll talk about decreases in transfer prices. And here, historically, Canada Customs said that because of this provision in the Customs Act, which was similar to a US provision, that you disregard rebates or other decreases in the price, they wouldn't let an importer claim a refund if the transfer price, if there was a credit at the end of the year because the transfer price was reduced. Now, if you move to the next slide, that position changed in 2015 as a result of some cases, and we actually had some appeals to Customs where we argued that under the law that retroactive transfer price adjustments should be allowed, downward adjustments, and refunds should be paid. And Customs came up with a policy that basically says if you meet these three conditions, then they will allow a downward transfer price adjustment and you can claim a refund. One of the key points here is that you can only claim the refund when the price goes down at the end of the year if you have an agreement in writing at the time the goods were imported that contemplates a change in the transfer price. Typically you'll see that in an intercompany agreement where there'll be a clause about the arm's length nature of the price, and that the transfer price can be changed prospectively or retroactively. So that's key. If you don't have that, Customs will deny your refund claim. And of course, there actually has to be a real credit given to the Canadian company, and you have to be able to substantiate that reduced price is an arm's length price. So I went over that really quickly, but again, it comes up a lot on audits, and we have companies every year that we help because every year they seem to have transfer price adjustments. If you go to the next slide, I think I want to just close on this with two key points. The first, obviously, is there's a real opportunity here to claim refunds back 4 years where there have been downward transfer price adjustments, and we have had instances where clients have come to us and we've helped them do that and obtain significant refunds. The flip side, though, isn't so great when there's a downward transfer price adjustment. if there's no duty that was originally paid, we call those entries revenue neutral entries. And because of this reason to believe concept, even though you're not claiming a refund or there's no refund to claim, technically, if the price goes down, if there's a credit at the end of the year, the importer does have to file correcting entries within the 90 days to reflect the fact that the value went down. Now, why is that? It's because Canada needs good trade statistics, and they want to know what the proper value for duty is for imported goods. Even though importers may argue, well, we declared too much, what's the harm? Customs wants the proper value for duty. And secondly, for exports from the U.S. to Canada, there's no U.S. export declaration. U.S. gets its export data from Canada's import data, and the U.S. wants good, accurate data based on what the proper value for duty is. And then quickly going to my last topic, this is this unique Canadian concept of what we call purchaser in Canada. So if you could flip 2 slides ahead, under the transaction value, the value for duty generally is the price paid or payable for the imported goods, subject to certain adjustments. And in Canada, under our Customs Act, we have this a special clause that says it's the price paid or payable if the goods are sold for export to Canada to a purchaser in Canada. And essentially that was added a number of years ago because Canada wanted to make it very clear that when you have a series of sales to Canada, that the value for duty should be based on the last sale, not the first sale. And many of you may know in the United States, provided certain conditions are met, the value for duty can be based on the first sale. So Canada's the opposite, and this trips up companies all the time. So this purchaser in Canada concept, essentially, what Customs is trying to say is we want a real substantial presence in Canada in order for us to be able to value the imported goods based on that entity's purchase of the goods. So the value for duty regulations define purchaser in Canada as a company, as an entity being resident. If it's not a resident, it has a permanent establishment in Canada. And if it's neither resident nor has a permanent establishment in Canada, the importer is importing those goods for its own use and not for sale, or it's being essentially bringing those goods in anticipation of a future sale. I'm going to go through each of these in a minute, but again, this comes up on audit all the time, and particularly between related companies. Sometimes a Canadian subsidiary will be established, and it's a legal company in law. It exists, it files Canadian tax returns, and it's buying goods and reselling them for its own account, but there's really no substance there. And in that instance, the company wouldn't qualify as a purchaser in Canada because it doesn't meet any of these 3 tests. So if you go to the next slide, I'll just focus on what's a resident for the moment. And for a company, a resident company means that it's carrying on business in Canada and the management and control is in Canada. And in many instances, particularly with Canadian subsidiaries of US companies, the management and control resides in the United States, not in Canada. And therefore, the company, again, while it exists in law, it buys and sells, it files tax returns, it's not a resident. So it doesn't qualify as a purchaser in Canada because it doesn't meet this test. Then you go and look at if we go to the next slide, the permanent establishment test, and that definition essentially means that you have to have a fixed place of business, so a place of management, an office, a factory, a workshop, through which you're carrying on business. And virtually, in most of the scenarios we look at, what we're focusing on is establishing that the Canadian company has a permanent establishment and therefore is a purchaser in Canada, and therefore the value for duty is going to be based on the purchase price from, say, its affiliate. Because what happens if you're not a purchaser in Canada, Customs will typically look at the next sale and say, oh, it's the Canadian company's sale to its customer, not the intercompany price, and the value for duty is much higher. So if you go to the next slide, the purchaser in Canada, the permanent established means a fixed place of business of the person through which they're carrying on business. And you can't, one of the comes up quite a bit. Companies will say, well, we have inventory sitting in a warehouse at a third party logistics company. That won't constitute a permanent establishment because you don't have control over the over the property in that third party's warehouse. Even though your employees might go and inspect it or do an inventory count, you're not really controlling that space. And so Customs says that's not your fixed place of business. And then lastly, to conclude, the third way is if you're not a resident and you don't have a permanent establishment, if you purchase goods in anticipation of a future sale, then you can still be a purchaser in Canada. So let's say you would have a U.S. A Mexican company, for example, purchasing goods and having them shipped to a third warehouse in Canada. In those circumstances, if they haven't pre-sold those goods or entered into agreements to sell those goods, the Mexican company's purchase price for those goods could still be the value for duty on the basis it qualifies as a purchaser in Canada because it's importing those goods into Canada in anticipation of a future sale. So the goods come into a warehouse, they sit there, and then someone tries to sell those goods out of the warehouse. On the other hand, if those goods are coming into a warehouse and there's already agreements in place to sell those goods or purchase orders, then the Mexican company won't qualify as a purchaser in Canada, and Customs will look to the Mexican company's customer and say that's the sale for export to Canada. The customer is the purchaser in Canada, and the value for duty is therefore based on that selling price to the customer. So my time is up, and I know I tried to cover a lot here. And again, and I know I'm speaking fast and not in Spanish, but the key takeaway in all of this, as I said earlier on, is Customs coming fast. It's time to refresh and look at your compliance programs with respect to do the goods originate, and part and parcel of that is to, I would think, if you're shipping to Canada, particularly to affiliates, be very mindful of these two value for duty issues that come up all the time on audits, and make sure that you are taking into account your year-end transfer price adjustments, and also you're understanding and compliant with the Canadian purchaser in Canada requirements. Unfortunately, I couldn't be in Mexico in person to be with you today. Obviously, given the COVID situation, I would love to have been there. But I would say if anybody has any questions regarding anything I've covered today, or more broadly Canadian customs issues, I'd be more than pleased to get on the telephone call with you or by email and see if I can address your questions. So I'm a little bit over. I apologize for that, and I do apologize for going quickly. But I think that's it for me. Yeah.
Thank you very much, Paul. Excellent presentation. Lots of information. Key takeaways for the Canadian piece of this, especially the last part of value. Very, very important. I bet that most of us in Mexico are not aware of those implications, and maybe with related parties. So it's been very, very interesting to listen to your presentation and the points that you have highlighted. We really thank you for collaborating with Index as our key partner as part of the Baker and McKenzie firm. And we would love to have you present in one of our conferences once this pandemic allows us to do that. But we really thank you. I remember our membership that throughout the conferences you're seeing this email, indexTv at index.org.mx, where you can send your questions to the specific speakers that have presented. If you have a question for Paul, make sure you address it, and we'll capture it, and we'll make sure either Paul or an email from Paul or any communication from Paul comes back with the answer that you may raise. Again, Paul, thank you very much for your assistance on this presentation. We enjoyed, and don't worry about the time. It was perfect.
Thank you. Thank you again for the opportunity. Appreciate it.